Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, passiveinvesting.com. Fill out the investor interest form. That's passiveinvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at passiveinvesting.com. And I'm so excited to be joined today by Jonathan Nichols. Jonathan, welcome to the show.
Hey, Whitney, glad to be here. Thanks for having me.
Yeah. Well, we're going to talk about Brookwood on 86, 100 units in Tulsa, Oklahoma. But before we dive into the details of that, tell us a little bit about yourself, how you got into the multifamily space, and where you're at today.
Yeah, so it's interesting. Growing up, I always knew one day I wanted to be an entrepreneur. I just had no idea what industry or specific business that I wanted to run. And so I went the route that most people in America do, and that was go to school, get my 4-year degree in aerospace engineering. And I actually worked as an aerospace engineer full-time for about 8 or 9 years. A few years into that, I got married to my lovely wife, Paula. And Paula informed me one day that we needed to have a hobby together. And so having recently read a book about real estate investing, I said, hey, what if we did real estate investing as a hobby? And then we could have something that pays us instead of us having to pay to do it. And so off we went. We're going to buy a single family home and just rent it out, basically. Then one day she comes home and says, hey, I found this fourplex. I think we should just house hack the fourplex and move there and just renovate it while we live there. And I thought it was the craziest idea I'd ever heard. I had no desire to leave my comfortable home, but after a little bit of persuasion, she got me to agree to the plan. And so that was our first investment deal that we did, was a fourplex here in Arlington, Texas, where we live. We actually turned it into a short-term rental. So think like Airbnb, Vrbo type thing. And then it went so well, in fact, that we continued to buy several other properties in that area over the next few years. Well, eventually we wanted to have a business in real estate investing that we could scale. And I'm sure as many of your listeners know, multifamily is one of the best avenues to do that with. And so we joined a mentorship program, went through it, did our first deal as multifamily syndicators a few years back. And then, of course, followed by a second and a third. And now we're both full-time multifamily investors. So live in Dallas, Texas, and focus on markets within Texas and Oklahoma. That's the short and sweet.
Nice. Very nice. What was the real estate book that you read?
Yeah, I was Rich Dad, Poor Dad, same as everyone else. I've always been an avid reader. And so a book like that, it's just like a firework going off in my head, And so I didn't know what I needed to do when I finished reading it, because it doesn't really explain that to you, but I knew I needed to do something. And that's what sort of lit the spark to get me down that investment journey.
Yeah, I always joke around people, especially on the Passive Investing Made Simple show that I run as well. I always joke around, I'm the one that read Rich Dad, Poor Dad and got it all wrong. But, it's really not a good game plan left for you at the end of the book, only the spark to go learn more about it. And I'm like, okay, done. I know everything. Yeah. That's awesome that you guys got support there and really learned how to syndicate properly.
Are you a passive investor looking to diversify your portfolio? The team at passiveinvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside passiveinvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy day cash reserve with a high yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit passiveinvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's passiveinvesting.com.
Let's dive in to one of your syndicated deals, Brookwood on 86, 100 units in Tulsa, Oklahoma. Let's start with the basics. What was the purchase price and when did you close on the deal?
Yeah, so purchase price was around $9.5 million. We closed it earlier this year, so June of 23. But we initially started looking at the deal the previous year in September. So September of 22 is brought to me off market from a broker relationship that I have here in Dallas who sends me a lot of deals. And he said, hey, I know you guys own several deals in Tulsa. Would you be interested in this one? And obviously I was interested right away because that's a market I'm interested in. But more than that, I was particularly interested in the submarket. So the property specifically is located in a submarket called Owasso, Oklahoma, which is just north of Tulsa a little ways. And to kind of give your listeners some perspective, the average median income, which I'm sure many people are familiar with, is a key metric in determining kind of the quality of the location, is about $95K within a 3-mile radius. So to give you an idea, like that's phenomenal here in Dallas. And so Oklahoma, it's a home run type of location. And so we started chasing after it, but it took a long time to convince the seller that, hey, we're the right buyers and you want to sell to us now. We went back and forth from September all the way until somewhere around February or March the next year before we actually got it under contract. And so it was a bit of an arduous journey, but we were really excited when we got the PSA signed.
Well, so how did you secure the deal? Like, what landed it for you? And were you competing against other groups? Was that the issue?
Yeah, that's a great question. So, I mentioned it was brought to me through a broker here in Dallas off market. So they did not have the exclusivity to the listing. It was more of just they had reached out to the owner at that time and, expressed interest in selling it. He said, yeah, if you bring me an offer around this amount, then I would be interested in entertaining a sell. And so we jumped on it right away, did the analysis, put in kind of a sort of soft offer, if you will, sight unseen sort of offer, just to get to the front of the pack. And then said, hey, when can we come tour the deal? And the response was like, well, actually, maybe I don't really want to sell it right now. I don't know. Maybe so, maybe not. And so we waited all fall, kept following up. And then we went and toured the deal officially. I think it was either the 2nd or 3rd of January this year. It was immediately after the new year. And put in an offer again, same offer, same price, which was the whisper price that the owner was asking for. And at that time, we thought, hey, we're probably going to win the deal. Well, he wound up actually listing the property with another broker that he was familiar with. And so basically just kind of cut our broker out of the deal. So then I had to go basically cold call this other broker and be like, hey, we've been pursuing this deal for months. We're a very credible buyer in this market. Here's our offer. We've already looked at it. And he was kind of like, well, maybe we'll bring it to market just to see what we can get, which I'm sure as your listeners know is kind of a death sentence on deals like this. And so it was a pretty tumultuous time. And we actually wound up increasing our offer a little bit to kind of sweeten the deal for the seller. And ultimately, we're able to get it under contract. But it was, just in the nick of time before they were about to market it. And then obviously a lot of challenges, working relationships between the two brokers and such. So probably the most challenging part of this was actually just getting the PSA on it.
Well, let's talk about the PSA. Like, how did you structure it? Was it a typical 30-30-30 or like, how did you structure it in order to win the deal?
Oh, in terms of timeline. Yes. So it was. Except we put hard money day one minus a few contingencies on the property. And so that's one way that we were able to win the deal was we had already toured it. The property manager that we use in that market was actually already running the property for the current seller. So we kind of had a backdoor of information as far as condition. So our really only concern on the property was the sewer lines. And it wasn't that we had a reason to believe there was a problem. It was an unknown. And so we'd already basically confirmed, hey, the roofs have been replaced recently. They're in good condition. It was basically 100% occupied. So you don't have any like burned units or anything like that. So it was basically the sewer lines we were concerned about. And so basically just put in an offer that said, hey, we'll do hard money day one, except if there's more than 100K of damage to the sewer lines that requires repair. And so we brought our plumber out in that market to take a look at it. And it wound up being like 20 or 25K worth of repair that was needed. And so we were well under our budget. And of course, that just sweetened the deal that much more for us. But yeah, as far as timelines, it was 60 days to close with a 30-day extension. One big learning lesson on this, and I'm sure we'll dive into the lending a little bit, but we were doing a loan assumption and we needed every single day of that timeline. And we actually even asked for an additional week at the end of our extension to get it closed because the assumption process was so lengthy and arduous. So that's kind of a first learning lesson for your listeners is that you might want to have a little bit longer than normal contract timeline if you're doing an assumption.
Good advice there. So we've got the property locked in. Yeah. How long was your due diligence period?
Yeah. So we finished all the due diligence. Let's see, since it was hard money, I always forget. I'm going to say 2 weeks. I think it was 2 weeks that it required for us to walk all the units, get all our vendors on site. That's typical for most projects that we do.
Okay. And did you guys find any surprises other than the 20 to 30K in sewer line repair?
Nothing major. I would say overall the property was in as good or better condition than what we suspected. There were a couple minor things that you see in properties like this. This is 70s built property. So like, there's bathrooms that need, GFCI outlets, or maybe they're a little bit older units and a few of them know what you think. Of course, you always find a couple hoarders, but nothing really beyond that, to be frank with you.
Okay. And how did the financial due diligence go on the property?
Yeah, so that was actually the easiest part of the whole deal because, as I mentioned, our current property manager that we used was already running it. And so the lease audit was super smooth. Property's full. We already know the requirements that they have. As far as the rest of it, I would say no big surprises. Once again, having the property manager that we use was pretty key in making that so seamless. But yeah, so no big surprises on that end.
Awesome.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFIN Con happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFIN Podcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Let's talk about like financing the deal. Okay, you did a loan assumption, and so 60 days to close. It sounded like you had your extension period, and then you had to extend again. Did you have to put any additional money down earnest money down in order to execute those extensions?
We did, yes, for both of them we did. And so I don't remember exactly how much, but let's say it was 1% was our initial EMD money, and then it was probably on the order of like 0.5% for that extra month. And then it was like another 0.5% for the additional week. So all in, we were about 2% on EMD, I would say. Yeah. And as far as lending, so it was a Freddie Mac small balance loan agency, financing on the property. The story behind is that the owner had actually refied the property about a year before we purchased it. I don't know if their intention was just to get it refinanced before rates went up, or if they had thought, hey, maybe we're going to hold this longer than what they did. But it obviously worked out very well for us and for them because they got a very competitive price on it. And so it was 3.5% interest at a time when you were looking probably in the sixes for new financing. Still had a year of IO left and step down prepayment penalty. So let's see, 7-year term, 1 year into it. So still 6 years left on a fixed rate loan. And then perhaps most importantly, and this I guess would be valuable information for your listeners, a lot of times the challenge with assumption deals is that the leverage that you get going into it is so low that it sort of negates any benefit that you get from the lower interest rate. So in other words, I might get a 3.5% interest rate, but I'm only 50% leveraged. And that usually does not work when you're bringing in investor equity of that level into the deal. So this one was actually leveraged at 71%, which is kind of, I would say, a sweet spot for agency financing in terms of, leverage amount. And then, of course, you had the 3.5% rate, the year of IO left. And so all those things to me back in September when we first started looking at the deal were key indicators that like, hey, this is a deal worth pursuing, worth putting the effort in as opposed to, just another assumption deal on the market.
I think that's a fantastic point. And also probably a testament to the seller for refinancing. Maybe they had a lot of equity in the deal. Not only did they want to use it and lock in a low interest rate, remove that equity so they could do whatever else that they wanted to do, but also getting it to appropriate leverage amount. That way, if they did want to sell it and somebody assumed the loan, it made sense. Right.
Yeah. One cool thing about the transaction, which I've been given permission to share this story, so it's okay. The broker, not the original broker, but the second one who was going to list it, he was not only the broker for the property, he was actually an investor, a limited partner investor in the deal. And when he called me to award us the deal, he's like, hey, I'd like to award y'all the deal, but I have to ask, would it be okay if I continue to invest in this deal? And I said, well, yeah, of course, you can be investor number one on it. And so that really gave us a lot of confidence. Hey, we're buying a great deal. Obviously, it's something that we shared with our investor base. Hey, there's a lot of confidence in this deal, even from the seller group, that it's going to be a great property going forward. And today, I guess I said 6 months. It's really a little bit more than that into the business plan. And we just did our second distribution on the deal, somewhere around a 6.5% cash on cash distribution, which is pretty unheard of in this market. So it's definitely taken off and investors have been pretty happy with it thus far. So.
And is that annualized 6.5%?
Correct. Yes.
I was going to say, your quarterly distribution, hold on to your hats.
No. So yeah, that's annualized.
Awesome. All right. So you raised capital for this deal. How much capital did you raise and how did you structure the deal with your limited partners?
Yeah, so it was about $4 million raise, which is about where a lot of our deals have been, quite frankly. And it's funny because I have students actually do some coaching through the same program that we went through. And I talked to a lot of my students that when we started in this industry with our partners, we would do $10 million deals and they would require a $2 million equity raise. Well, today we're still doing $10 million deals, but they require a $4 million equity raise. And it's twice as hard to get each dollar. And so, yeah, this project was a $4 million raise. And I had seen a lot of people in the syndication space that had stalled on raises recently. And then they're just kind of clawing to the finish line, hoping to get what they need. And I really didn't want to do that. And so my mindset or my belief is that you win at the raise up front, right? And so it starts with building a good team of co-GPs on the deal that can get you across the finish line. So I like to work with people that I've worked with before that have, a proven track record. They know how to raise. They have investors who are interested in the market and the kind of deal that I'm doing. And so I assembled a team and we actually put one additional co-GP than what we thought we were going to need onto the deal. so that basically we were in excess of the raise. And so that really gave me a lot of confidence, because then going into the webinar, the statement was basically, hey, we need 4 million. We have soft commits for, let's call it 3 or something. Like, we expect this to be fully subscribed soon, and just kind of create that FOMO, if you will, with investors. And I know that everyone does that on their webinars. And sometimes it's like, well, is it kind of false advertising if you really don't have that pipeline of investors? But we really did. And so it was like, hey, I recommend filling this subscription document and investing if you want to be a part of this deal. And so we had it in the evening, let's say 7 p.m. and we were fully subscribed by like 10 or 11 a.m. the next morning. So as difficult as the assumption process was, the raise for this deal was extremely easy. And there's really several things. So, I already mentioned, starting out with a good team, but beyond that, having a good deal. I think investors are tired of seeing mediocre kind of deals in the market where it looks like a sponsor is just doing a deal to do a deal. No one wants to be involved with that, especially in this economy. I also think that, having the right people on your team that have a track record of success with their current deals is really important. If you have a co-GP that has 3 deals with capital calls, you're going to have a lot harder time convincing their investors to join the deal than if everyone's deals are running well. And so just kind of having that investor trust and demonstrating to them why this deal is worth their attention and ultimately their investment is really key if you want to knock the raise out of the park.
Awesome. So how did you structure it? Like, what was the splits? Were there any hurdles involved?
Yeah. So it's 70-30 split, 7% preferred return. We always do preferred returns on our deals. I know people kind of go back and forth on it, but that's kind of how we do it. And then typically what we do is we're a little bit lighter on fees than some groups. We do have an acquisition fee, but what we usually do is just if we exceed the projections, we'll go to a 50-50 waterfall a little bit sooner than some groups will. So we don't fee as much as some. But if we're able to beat those projections, then we get our reward kind of on the backside above and beyond what we initially projected for the deal.
So what IRR hurdle do you switch it to 50-50?
Yeah. So don't quote me exactly on this, but like if it's I think this deal was somewhere in the 16% IRR projected, we'll probably switch it like 18, something like that. Above that, we'll go 50-50.
Okay. And then what do you usually charge for acquisition fee, capital event fee, stuff like that?
Yeah. So acquisition fee, this deal we did 2.5%. I would say we've gone between 2 and 2.5 on most deals, just depending on the deal size. We have one deal that we did, I think it was 1.5, kind of early on our syndication career. Never again. It's not worth the time or the expense, honestly, as a sponsor, or the risk, especially when you're talking about putting 1 or 2% hard earnest money on deals that you could lose. One key thing about me personally, and not everyone necessarily, all my partners don't necessarily do this, but I always invest my acquisition fee back into the deal. And so that's kind of what I've always told my investors is like, yeah, I want to get paid for the work up front, but we'll invest the fee back into the deal, kind of in good faith that we're going to continue to work hard on this all the way to the finish line. As far as other fees, mentioned capital event, we don't charge that on our deals. I don't do capital event, or sometimes we'll have a refinance fee, but like a deal like this, there's no planned refinance in it because that's kind of the sweet part of the deal is the loan itself. Yeah. So I think that kind of sums it up in short.
Yeah. And what about asset management?
Yeah. So we usually do have a 2% asset management fee. In this particular case, I have a couple partners that they work with our property manager in this market. And so they're the lead asset managers for the project because they basically are in that market, like physically in the market all the time. And so we give, 100% of the asset management fee goes to them because they're doing that work. So, but usually 2% is what we put on our deals.
Okay. And then you've mentioned a couple of times that you have partners within the general partnership that are working with you on this deal. You tell us about that, how you've structured that partnership. How many partners are there?
Yeah, that's a great question. So this deal, we had 4 partners. I'm a huge fan, both myself and if I pull people in a deal, that everyone is an involved partner. So like I don't pull people in just to raise money to deals. They have an active role on the partnership as, required by the SEC. And so a couple of the partners, they're another couple that we work with, and they focus specifically on deals in Tulsa. And so I've been a co-GP on a couple of their deals. So obviously when I found this deal, they were first people I was going to invite on the deal. And they're the ones that do the asset management I mentioned. And so, we have a very organic relationship or partnership just due to not only mutual interest in investing, but in the markets that we're interested in as well. So, I've passively invested in one or two of their deals and they've passively invested in one or two of mine. And so we have a pretty good relationship. And then the other two partners on the deal are people who have partnered with us on other deals, both in Oklahoma and in Texas in the past, to raise money, help with the acquisition, put down risk capital, work with investors and other responsibilities as well.
Awesome. Well, let's wrap up. I have a couple questions for you.
Sure.
What did you think was going to be easier on this deal that ended up being harder? I think I have a clue. And then what ended up being what did you think was going to be hard that actually ended up being easier?
Yeah, so I've already kind of alluded to it, but just to kind of give it a little more color, the assumption was very difficult. So if you think about it like this, when you go, you don't work for people maybe who are newer to syndicating. When you talk about agency financing, you don't work directly with the agencies, right? There's sort of a broker, a mediator that goes between you and them. In this case, it was CBRE. And typically, those brokers will charge a point on the loan balance to originate a new loan or new financing on a deal. But not always, but in this case, they will not charge that point if you're doing an assumption or a transfer of interest of the loan to a new party. And so what it basically means is that they're kind of working for free in a sense. And so let's just say that you don't get the A team from their group when you go through this assumption process. So there's a lot of hand-holding, a lot of just calling on the phone, checking in on things, and a lot of things just, quite frankly, not being done well. And so you as the sponsor kind of have to take up that slack to keep the ball rolling forward and to make sure that things are being done correctly and on time. And so that was definitely the most challenging part, especially towards the end where they're not necessarily on a timeline, but you are. And so that was very difficult. The raise, I guess it may be a little unfair to say I thought it was going to go bad because I don't think that's true. But I had heard and seen from a lot of other sponsors that there were challenges with raising. And I tried to situate the team and our investment to where we wouldn't have those problems. But it was definitely a pleasant surprise when we were fully subscribed as quickly as we were. So that part was really nice.
Awesome. Well, Jonathan, thank you so much for sharing your knowledge and expertise with us here today.
Absolutely.
If people want to follow you and find out more about you, how can they do so?
Yeah, there's really two great ways. One, you can go to our website. It's Apogee MFC, like multifamilycapital.com. We've got a ton of information and resources, contact forms there. Also, I'm super active on LinkedIn. So if you look up Jonathan Nichols on LinkedIn, I'm pretty easy to find.
Awesome. Well, again, Jonathan, thank you so much for sharing your knowledge and time with us here today. We look forward to hearing about your future deals.
Appreciate it, Whitney. Thanks for having me.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.